Your degree certificate is not what really matters, but what you learn in your MBA course does. If you think you can start and scale up a business without any knowledge, then everyone would be a millionaire. There'd be no point of doing MBA. Every rich person has read a ton of books and is well versed about how the financial system and its components work. Every individual wants to be financially free, but the one who truly understands will achieve it. This will help you make better decisions at the financial aspects of your life, whether you're a proprietor, partner, or financial manager of a company. There are many career opportunities in finance,
like investment banker, hedge fund manager, accountant, financial analyst, etc. Though having a degree will guarantee you to land a successful job, doesn't mean you could do it without one. Career in finance is a very competitive field, thus having immense knowledge about it will help you excel in it. To really become a rich person means to put triple the efforts of a normal person, work for countless hours, and reach out to more people and take part in interns to create a strong portfolio. Now, this channel is not based upon generating income through means of e-commerce or online methods such as dropshipping, copywriting, or affiliate marketing. Rather, we'll be focusing on the core concepts of finance and wealth maximization through savings and smart investing methods. Whether you're a worker at McDonald's or an employee at a corporation, you can learn the basic fundamentals of investments and key concepts of finance to help you build wealth. In this video, we'll go through the 6 important principles of finance. But before we do that, you'll need to know something. What is finance? Finance is the circulation or flow of funds, financial instruments such as currencies, loans, shares, stocks, bonds, options, futures, etc., and assets having underlying values between the investor, financial markets, and the financial intermediaries. We'll talk about financial markets and intermediaries in the later videos, but for now, let's get back to the 6 principles that you should know as a person who's into finance. Time value of money. Say you save up $100. Now, this principal amount that you have saved won't have the same value as before in a few years. Due to inflation, its value would have decreased over time. But why would this happen? What causes its value to inflate? When the prices increase over a period of time, say the rent at the place you're living at, or certain essential services, it makes the cost of living to live in the state high, hence inflating the value of money. Another reason is the low interest rates, which helps stimulate the economic activity as consumers can now spend more. The second one, higher ROI with more risk. Now, I'm not saying that you should deal with investments which are really risky, but taking calculated risk and being precautious will end up giving more return on investments. Let's take an example. We all know the value of gold will not fall hard and will have a uniform growth over the years, making it a not so risk-involved investment. Whereas the stock price of a company or the value of a cryptocurrency might hit lows over the night and can even increase rapidly, making it a much more riskier investment. In general, you don't get something for nothing. Practically, to get a high return would mean to accept an unusually high level of risk. Warning, this doesn't include gambling. Number 3, diversification of risk. Say a stock analyst on CNBC hints the public that the stock price of a particular corporation will grow, and so you decide to go all in on it. But for some reason, the very next day, Jerome Powell decides to talk about the company's stock, which would in turn make its price take a huge dip and you would lose all your money. Instead, what you could have done is invest a bit in the company and the rest in other few. Now, you don't have all your eggs in one basket, so even if half of your investment is in loss, the other half would still be there to back it up. And this is where mutual funds comes in. We'll talk about it in some other videos along with the other debt securities. Number 4, limiting debt for income. When you buy a rental property using a loan, you can repay it back by the income you generate from the property. But if you buy a car using a loan, unless you drive for a living, it is not a good investment. When you're young, especially in your 20s, it's best recommended to save more and invest rather than getting into debts for assets that don't create your wealth. Saving and investing in your early years is the best way to maximize your wealth for the future. Avoid spending unnecessarily. Always remember to never spend more than what you make. Number 5, budgeting. This is one of the most efficient ways to have a better financial life. There are many budgeting methods, each offering their own advantages. But usually a budgeting plan consists of your net income, spendings, investments, and etc. This will help you track your cash flow more efficiently and make changes. There are many budgeting softwares. Using them will make it less time-consuming to track your investments and spending. For example, BlackRock, an investment company having $10 trillion worth assets under management, they offer services such as wealth planning and financial consultations. Number 6. This is the last one, but the most important one. Emotional intelligence. According to an article from Forbes, basically higher EI tends to correlate with more rational decision-making, which can be beneficial, particularly when making financial decisions that can impact long-term financial wellness. No matter how high your IQ is, in finance, having control over emotions and thinking rationally is the key to having great financial health. A hedge fund group known as Long-Term Capital Management, LP, controlled by a group of mathematicians, computer scientists, and Nobel Prize-winning economists, had faced a loss of $2 billion in the span of 2 weeks. This proves that high IQ has got nothing to do with investing. Rather, it's a subject based on emotional intelligence. Remember, having good ethics is important too. Don't try and evade taxes or promote fraudulent topics. In the short term, it might help you get what you want, but in the long run, you'll have many problems. And if anyone's offering you a high ROI with no risk, then be skeptical about it.